Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$501.29. That was a number glaring at everyone from the tape when the market closed on SanDisk yesterday, January 21st, 2026. We even tapped, an intraday high of $515.20? But if you were just staring at the price, you missed the real story. The real story was the volume. We saw 17.36 million shares trade hands. That is well above the average of 16 million. So what we're looking at right now isn't just a stock ticking up. We are witnessing a massive volume expansion, confirming a 70% year-to-date gain. And remember, we're only 3 weeks into 2026. If you zoom out just a little bit further, this asset has appreciated over 900% since the spinoff from Western Digital back in February 2025. This isn't speculation anymore. This is the market finally waking up to the structural re-rating of the only pure-play asset in the memory supercycle.
Okay, hold on. You call it a structural re-rating. I call it a vertical liquidity event. I mean, I'm looking at the same tape, but I see a panic, not a graduation. When a large cap stock moves 70% in 11 trading days, that defies every standard volatility model on Wall Street. We are currently sitting in the 94th percentile for implied volatility rank. That doesn't scream healthy organic growth to me. That screams mechanical dislocation. But it looks like a parabolic move driven by a complete vacuum of sellers and a massive squeeze that has become, frankly, totally disconnected from the fundamental gravity of the company. You can't just wave away the physics of the market because the chart looks pretty.
I get that the velocity is scary. It's vertical. But you have to look at why that vacuum exists. This isn't happening in a void. The separation from Western Digital has finally unlocked value that was trapped inside that conglomerate structure for years. And you have to think about what that actually means operationally. The conglomerate discount is gone. But more importantly, look at the balance sheet transformation. SanDisk is now net cash positive. They reduced debt by $368 million.
Right.
For the last 5 years, SanDisk had one hand tied behind its back, servicing debt and begging for CapEx approval. Now, that $368 million reduction means they are free. They don't need to ask Wall Street for permission to innovate. In a high-interest rate environment, being self-funded isn't just a nice-to-have line item, it is a fortress. That is a massive competitive advantage that the market is finally pricing in.
The balance sheet is cleaner, I grant you that. Being net cash positive is great, but let's be real. A clean balance sheet justifies a 20% premium, maybe 30%. It does not justify a 900% move in under a year.
You're trying to use fundamental metrics to explain what is, at its core, a technical anomaly.
It's not just the balance sheet, though. It's the perfect storm of catalysts we got right at the start of the year. On January 6th, we saw that 22% single-day gain. Why? Because you had TrendForce coming out and putting a number on it, predicting 33 to 38% price hikes in NAND contract prices for Q1 alone. Not for the year, for the quarter.
Then you layer on the NVIDIA commentary regarding storage needs. The market is realizing that we are entering the memory wall era. Storage is no longer a commodity you buy by the pound. It is as critical as compute for AI inference. That is what's being priced in. The market is realizing they were valuing a strategic partner like a commodity vendor.
Look, I see the growth narrative, and I read the TrendForce report, but I don't buy the sustainability of this velocity. The stock is currently priced for absolute perfection. And when you have a move this violent, 70% in less than a month, you are inviting a scenario where any slight miss, any hiccup, leads to a catastrophic unwind. This smells exactly like the double ordering phenomenon we see in every single semiconductor cycle. Customers panic buy because they hear about shortages from reports like TrendForce, which drives prices up, which creates a glut later. We are seeing a vacuum of sellers right now, sure, but that can change instantly. The door to get in was wide, but the door to get out at $500 is going to be very, very narrow if the narrative shifts.
I think you're stuck in the old cycle mindset, and you're missing the structural change. But okay, let's dig into the mechanics, because I know you think this is just a squeeze. Let's talk about the microstructure.
It is a squeeze. You have to look at who is buying. We have short interest sitting at around 8.8 million shares. Now, people look at the days to cover metric, which is at, 0.75, and they say, oh, the shorts can cover in less than a day. That is such a misleading metric because the daily volume is exploding. You have to look at the nominal value of those losses. Think about the psychology of the short seller here. Shorts who entered this trade at $200 or even $300 thinking the top was in are sitting on catastrophic career-ending losses. When the stock breached $400 and then ripped through $500, those weren't investment decisions being made. Those were margin clerks taking over the accounts and forcing mandatory covering. That creates artificial buy pressure. It's mechanical buying, not fundamental conviction.
I strongly disagree that this is purely mechanical. If it were just short scrambling to cover, the price action would be erratic and sloppy. But look at the depth of institutional action we're seeing in the dark pools. We are seeing significant block trades executing in dark pools, which tells me institutions are accumulating at volume-weighted average prices, or VWAP. They are trying to build positions without spiking the market further. They're hiding their footprints. But the smoking gun that kills your just a squeeze theory is the filing from yesterday. BlackRock filed an amended 13G on January 21st. They have taken a 6.0% passive stake. That's 8.8 million shares.
It's a big number.
It's not just a big number. It is a supply shock. While the message boards were obsessing over the intraday chart, BlackRock quietly locked up 6% of the company. That is 8.8 million shares taken out of circulation. You put that in the vault. So if you're a short seller, the wall's just closed in on you. You can't cover your short position with shares that are sitting in a passive index fund's vault. That's not a bubble. That's a supply crisis meeting institutional accumulation.
Okay, but BlackRock is an indexer. They buy because they have to match weightings, not necessarily because they believe in the alpha. But let's look at the people who actually know the company intimately, the insiders. If this super cycle is so guaranteed, if this structural re-rating is so obvious, why aren't they buying hand over fist? In fact, we saw Director Nishi Sainer sell 1,271 shares in December.
That was at 195. That was ages ago in this market.
Exactly. He sold at $195. The stock is now over $500. So if an insider didn't see the value at $200, why should we believe the value is there at $500? Sure, it's a small sale, likely for tax purposes, but it's not buying. There is no open market buying from the C-suite to support this valuation. You have BlackRock buying because the algo tells them to, and you have shorts buying because they are being liquidated. That is a dangerous mix for a retail investor entering at $500. You're swimming with whales who don't care about price and desperate shorts who have no choice.
I think citing a 1,200 share sale from December is grasping at straws compared to an 8.8 million share buy from the world's largest asset manager in January. But okay, let's talk about the valuation properly, because I know you think it's expensive. I argue it's finally catching up. SanDisk is trading at roughly 9.41 times sales. Let's look at the peer group to see if that's crazy. Micron is trading between, 9.7 and 10.3 times sales.
Micron is a DRAM company, though. The economics are different.
Micron is a memory company exposed to AI, just like SanDisk. The market has historically discounted SanDisk because it was seen as a cheap commodity NAND vendor. But now, with the shift to enterprise SSDs and the data center buildout, SNDK is closing that gap. In fact, SanDisk has outperformed Micron massively year-to-date, up 74% versus Micron's 27%. That proves the market prefers the pure NAND exposure right now. The market is explicitly saying that in the AI inference world, storage is the bottleneck, not just memory. They are paying a premium for the pure play.
But you can't just cherry-pick Micron. You have to look at Kioxia. Kioxia is SanDisk's manufacturing partner. They share the fabs in Yokkaichi. They make the exact same chips coming off the exact same wafers. Yet Kioxia is trading at a market cap of around $54 billion, while SanDisk has ballooned to $73.5 billion. That is a nearly $20 billion disconnect for two companies selling the same technology from the same factory. That makes no fundamental sense.
Oh, it makes perfect sense if you understand capital markets. That premium is justified by liquidity and market access. Kioxia just IPO'd in Tokyo in December 2024. SanDisk is on the NASDAQ. It has access to the deepest capital pools in the world. You pay a premium for U.S. liquidity. Plus, SanDisk has a much stronger brand presence in the enterprise SSD market, specifically with the hyperscalers in the U.S., which is where the high margins are. You aren't just buying the wafer, you're buying the customer relationships and the NASDAQ listing.
Or you are paying a premium because of a bubble. Look at the analyst coverage. We have a serious contrarian risk here. Currently, 0% of analysts have a sell rating, not one. Citi just raised their target to $490. Bernstein is chasing the tail with a target of $580. When everyone is on one side of the boat, when there isn't a single dissenting voice on Wall Street, the risk of a reversal is at its highest. There is no one left to convert to a bull. They're all already in. When Bernstein says $580, that usually means the top is near.
They are all in because the fundamental technology driver is undeniable. And this brings me to the core thesis that you're glossing over: high bandwidth flash, or HBF. This is what the analysts are really pricing in. This isn't just about selling more SSDs.
Which is essentially a science project right now.
It is not a science project. It is an architectural breakthrough. Think of it this way. Right now, your H100 GPU is like a Ferrari engine. It's incredibly fast, but it's sucking fuel through a tiny straw because the storage is too far away. That's the bottleneck. High bandwidth flash changes the plumbing entirely. It stacks the storage directly next to the compute using TSVs through silicon vias. It turns that straw into a fire hose. We're talking about 4 terabyte stacks sitting right next to the logic. This solves the single biggest bottleneck in AI inference: storing trillion-parameter models locally. Right now, models have to be fetched from external SSDs, which is just too slow. And the partnership with SK Hynix to standardize this gives it a massive stamp of approval.
That is a compelling narrative, I admit. The Ferrari analogy is cute, but narratives don't pay the bills. Execution does. HBF is unproven at scale. Sampling is only targeted for the second half of 2026. Commercial adoption is 2027. The current valuation of $500 a share is pricing HBF as if it is already a guaranteed commercial success. If there is any delay, any integration issue with NVIDIA or AMD, or if the thermal management of these 4 TB stacks proves difficult, which it likely will, the derating will be violent. You are paying 2027 prices for 2026 execution risk.
The market is forward-looking. It's pricing in the monopoly SanDisk will have on this specific tier of memory. But even if we put HBF aside, just look at the current pricing power. We are seeing 38% price hikes in Q1. That is immediate cash flow, and this is supported by the macro data we are seeing on Polymarket.
Well, I'm glad you brought up Polymarket because I think the data there actually supports the bear case if you look closely.
I disagree. The prediction markets are showing high confidence in a hardware shortage. But more importantly, look at the correlation with the smartphone market. Global smartphone shipments are predicted to drop 2.1% in 2026. Why? Because of rising memory costs.
Exactly. Demand destruction. That's usually bad for business.
No, in this specific case, that is bullish. It proves pricing power. SanDisk and the oligopoly are raising prices so aggressively that it is destroying demand at the low end, the cheap smartphones. And frankly, they don't care. They are shedding the low-margin volume to shift their mix to the high-margin AI data center sales. They are trading pennies for dollars. They are shedding the fat to chase the muscle. That is the holy grail for semiconductor profitability.
That is a very optimistic way to spin a decline in global shipments. We're losing customers, but it's good for us. But look at the other contract on Polymarket. The AI bubble burst by 2026 contract is trading at a 40% probability. SanDisk is effectively a derivative trade on the AI bubble. If the software bubble bursts, if the monetization of these chatbots and agents fails, the hardware CapEx cycle freezes instantly. SanDisk is inversely correlated to bubble fears. If that fear rises from 40% to 60%, SanDisk stock isn't staying at $500.
But the CapEx cycle is committed. Microsoft, Meta, Google, they are building these data centers regardless of whether the chatbots are profitable next quarter. The infrastructure build-out is a multi-year trend, and SanDisk is the primary beneficiary of the storage component of that build-out. They can't stop building halfway through.
Let's talk about the immediate future then. We have earnings coming up on January 29th. The stock has run up 70% into this event. This is the classic buy the rumors, sell the news setup. The market is front-running a beat. If they beat, well, it's expected.
If they miss, or even just meet expectations, the air comes out of this balloon very, very fast. The expectations bar is now set at the stratosphere.
I agree that the January 29th call is the critical moment, but the floor is higher than you think. With the supply cuts from Samsung and SK Hynix and BlackRock locking up that float, the downside is protected. The metric to watch is gross margins. In Q4 2025, they were at 26.4%. Guidance suggests 29%. If they break the 30% barrier, it confirms the pricing power thesis is accelerating. That justifies the move to the Bernstein target of $580. A 30% margin profile for a NAND company changes the valuation multiple permanently.
And I would argue that even if they hit 30% margins, the stock has already priced in 35%. The risk-reward here is skewed entirely to the downside. You are chasing a parabolic move in a cyclical industry known for double ordering and sudden gluts. Despite the buy ratings, this technical setup leaves absolutely no room for error. You're picking up pennies in front of a steamroller at $500.
The easy money might have been made, I'll concede that. But the trend is fundamental. We are witnessing the revaluation of storage in the age of AI. It's no longer a commodity, it's strategic infrastructure, and SanDisk is the only pure way to play that. And when the big money, like BlackRock, steps in with that kind of conviction, you pay attention.
It's a strong company, I don't deny that, but it's a dangerous stock at these levels. Investors need to decide if they are investing in the company's future or just providing exit liquidity for the smart money that got in 6 months ago.
And that is where we'll leave it. The January 29th earnings call will be the deciding factor. If those gross margins break 30%, the supercycle is confirmed. If not, the skeptics might have their day.
We'll find out in a week.
Indeed, we will.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.